everyone. Just to start, my name's Foll. I co-manage Law Debenture. I've been joint PM since 2019, and I've been involved in the trust since 2011. I co-manage it alongside James Henderson. And just before we go into the UK economy, a brief word on Law Deb. It's a £1 billion market cap UK equity income trust. We've been, as you can see here, we've been maintaining or increasing our dividend for the last 45 years. We've got a strong performance track record. At the moment, the yield on the trust is just under 4%, and we pay that dividend quarterly. So if we flick to the next slide and start with the UK economy, and even though those that follow UK equities know that UK equities are actually very international, the FTSE All-Share, the earnings are around 3/4 overseas. So you could say that focusing on the UK economy itself is a bit odd, but I always feel that when it comes to UK equities, if people are to be interested, you almost need to get them over the hurdle of thinking that the UK is almost the sick man of Europe. That does seem to be the economic perception these days. And I don't think that's rooted in reality. So I just wanted to cover that and describe why. So if you can see the top graph here, this is the UK consumer balance sheet since the financial crisis. And the red line is household debt, and this is across the whole economy. We've always got to be careful of averages. So this is the average household debt in red and average household savings in green. So what you can see is over the last 15 years or so, that households in the UK have been bringing their debt down and bringing their savings up to the point where actually when the COVID stimulus kicked in, which is when the green line sort of suddenly ticks up there, that debt and savings net each other out. So on average, again, this is an average, people don't have net debt. They have a neutral balance sheet. And you can think of this as almost taking some cash out of the economy very gradually over the last 15 years or so. People have been gradually sort of squirreling away. And even more so recently with the UK savings rate ticking up to around 10%, much higher, by the way, than the US, where people have carried on spending. So even though we think about the UK having a fairly flatlining economy, and we actually went into technical recession in the second half of last year, part of that is because the UK consumer has been much more conservative than some of its peers, again, particularly the case in the States. And the reason I'm focusing on the consumer here is that household spending is about 60% of our overall economy. So what really matters to the UK and the UK economy is whether the consumer feels differently and wants to go out there and spend. And if we look at, if we try and drill down and say this year, so this is the chart at the top is a very long-term chart going back to the financial crisis. But if we think about where the consumer is right now and look at post-tax income for this year, so 2024, and take off everything that you have to spend money on. So think things like energy, fuel, food, net all of that off. The average household is getting a 10% increase in their net of everything income. So you have, on average, 10% more money. It might not feel that way this year because of things like the national insurance cut that the government's put in, because of things like the energy price cap coming down. That's a very meaningful amount that the consumer has extra to spend. And that's why you can see the consumer confidence data here, which is the second graph, starting to tick up, albeit from very low levels. So there are signs that the UK consumer is in a better place. And again, the consumer is really key to overall economic momentum in the UK. You flick on to the next slide, which is the UK market backdrop. And Dan did touch on this already, so I won't spend too much time talking about it. I think you've probably heard it elsewhere as well. UK equities are trading at a big valuation discount to the rest of the world. And here on the chart on the right, we're using the MSCI World as a proxy for that. And you can see over the last 25 years, UK equities have almost always traded at a discount. That's what that 0.85 median line in the middle there is showing you, that UK equities normally trade at about a 15% discount, but not an almost 40% discount, which is where they are at the moment. And it doesn't take anyone super eagle eye to spot that the moment of change is mid-2016. Now, we all know what happened in mid-2016, and people will have different opinions on that. But going back to what I said right at the beginning, actually 75% of the earnings in this market are overseas. So that makes this chart, in my view, particularly illogical, because if you think about, say, the GSKs of the world in pharmaceuticals, think things like HSBC, these are companies that happen to be listed in the UK, but they could just as easily. So this valuation discount isn't particularly logical when you think about that overseas element to the UK market. So from a law debenture perspective, we see this valuation discount and we think, okay, well, this is the opportunity. And we have been moving more money into the UK, and we now have a 90% weight in UK equities, which is higher than it's been historically. If we flick on to the next slide, which is almost going back a step, and I felt like this needed to be covered because I think people spend a lot of time talking about valuation levels and maybe not talking about why they matter. So what this chart on the right says is, so every dot on this is a year going back to the 1970s, and it says, what valuation did you start at? That's on the x-axis, the starting period per year. And where did you end up 10 years later in terms of your real return per year? So this portfolio, Law Debenture, is now on 10, as at the end of March, it's at 10 times forward earnings. So if we take this graph and say, okay, 10 times, and draw up there to the line of best fit, the worst year that you started at 10 times earnings, you would have made about 6% real return per year. And then at the best time, you would have made 14% odd return per year. You would hopefully be happy with the 6%. Remember, this is real per year. So after everything, after inflation, 10 times, history would suggest you would make a good real return 10 years later after that. And the whole UK market, by the way, is on 11 times. So not too much different. Again, if you scroll up from 11 times, you're looking at a 4% plus. History, remember, this is not looking into the future. This is just historical numbers. The US market, on the other hand, if we take where that is now, so 21 times, and again, just sort of scroll up, at the worst point, that would have made you 0%. The best would have made you 3%. So nowhere near as attractive, again, based on history. Now, you've got to always remember that the cheap can remain cheap and the expensive can remain expensive. But this is a long run graph, and it shows that valuations do matter. There's a very strong correlation here that you can see between valuation and end result. So this perception, if you think valuations don't matter, what you're arguing is that this time it's different. And you've always got to be a bit careful of that sentence, in my experience. So valuations do matter. And if you're starting at a low valuation, what you're effectively doing is stacking the odds more in your favour. So if we flick to the next slide so that's the UK as a whole, but where do we see particular opportunity? And just before I start on some specifics, with Law Deb, we have 150 holdings here. So we're not running a thematic approach. It's not run on any one particular theme, but there are a few areas that I wanted to just draw out. The first is domestic recovery. So going back to that first slide about the UK economy being in a better place than people necessarily think, there are some stocks that we think are particularly well placed to benefit from that. And I loved Dan's description of unglamorous companies, because there are certainly some unglamorous companies within this portfolio, but ones that are glamorous in what we think they can achieve in terms of total return. And what I mean by that is where you get a really powerful compounding effect is where earnings recover and valuations can recover at the same time. And I think there's some really good examples of that. I'm going to talk about Marshalls in a sec, which is paving stones, but it could equally apply to a number of other companies we own. Shaftesbury is property in the West End. ITV, of course, everyone knows what ITV is. I often get a kind of sharp intake of breath from people when I say we own ITV. Free-to-air TV, I don't think is dead. There is still a good return on investment for getting in front of that Saturday night audience, huge numbers of people in a brand safe way, in a way that if you're putting your ad on YouTube, you still don't quite know what you're being advertised alongside. If you're going on ITV on Saturday night, you know exactly where you're going. So there is still a role for something like ITV. And again, if the economy comes into a slightly better place, that's a company where sentiment is very poor. and the valuation is much lower than it's been historically. So I'm going to talk a bit more in a sec about domestic recovery. There are also some world-leading companies in the UK, and Dan talked about us not having much of a technology sector. And yes, I mean, that's clearly factually right. We don't have much of a tech sector. That does not mean we don't have some companies that are incredibly rich in intellectual property and, tech savvy. RollsRoyce is you could argue it's the market leader in jet engines. Again, I'm going to talk about it more in a sec. Ceres Power, one of the world leaders in hydrogen fuel cells. If you want to stick with larger companies, something like GSK, world leading HIV drugs. We've got Oxford Nanopore in this portfolio, one of the world leaders in DNA sequencing. There really is good tech in the UK. It might not necessarily fall into the technology sector, and I'll talk more in a sec. And then, again, Dan touched on this very well. We are seeing quite an extraordinary number of takeovers, actually. I can't think of a time when we've had almost, I'm genuinely not exaggerating, almost every day at the moment we are getting a takeover bid in. Within the last week or so, we've had IDS, which is Royal Mail. We've had Hypnosis Songs Fund, which is a music rights catalogue business. And then today we've had Anglo American. And what's interesting is that it's not only private equity, it's such a mix. It's PE, it's overseas companies. It's sometimes now UK on UK companies, which we haven't seen historically. And it's across all sizes of companies, small, medium and large. And I think it's a reflection of just the sheer valuation opportunity across actually all sizes of UK company. If we flick on, yes.
No, I'm sorry, Lisa here. Do you mind just popping your mic a little bit further away from your mouth? Just that it's getting a little tiny bit of feedback. Just might be a bit clearer. I think that might be better. Thank you.
And if it's not, then just let me know. Okay. If we flick on to Marshalls, which is the domestic recovery example, this is very much unglamorous, as Dan was saying. This is paving stones. I've called it landscaping materials here, but call it what it is. It's paving stones. You can see this in this lovely picture. It also makes the likes of roof tiles and timber. And the potential opportunity here is that volumes in this area have been very, very challenged. House builders have pulled back on volumes. The average person has also pulled back on things like their patio spend. This is one of those areas where people spent quite a lot of money during COVID and then pulled back during recent cost of living pressures. So volumes are down roughly 30% on where they were in 2019, but the company has responded to that by bringing costs down materially. But the nice thing about a company like this is there is no structural problem. It's paving stones. There's no AI risk to get your head around here. We will still want patios in 10 years' time. I feel pretty confident saying that. We will still want to do civil infrastructure spend. So volumes could and should recover, but it's a tougher environment right now. And what management are saying is that when volumes recover, so say they go up 20% from where they are now, so not back to 2019 levels. And by the way, 2019 was not a particularly stellar year, but say they do recover 20%. Management are guiding to earnings per share almost doubling. They're going from 15p, where they are roughly at the moment, to going to 33p. And the nice thing about that is that no one has anywhere near that in their forecast. You can go out to 5 years and beyond. No one wants to be the brave analyst that forecasts that level of earnings growth. So going back to that point around the potential compounding effect, you've got a company where the valuation is lower than it's been historically, and the earnings should recover. But what we absolutely can't say is when. And that's actually fine in a portfolio context because, as I mentioned, we've got 150 holdings here. We can have some that are firing right now, and I'll go on to talk about Rolls. That's definitely one that's doing well right now. But Marshalls might do well in a year's time, 2 years' time. We don't know when those volumes are going to recover, but they should at some stage. And that's the beauty in a way of running a portfolio that can take a longer term approach. If we do Rolls, and you can't argue that Rolls is a UK world leader, and it's been a world leader for a long time, but it hasn't realised the potential of that. until very recently, until effectively a new CEO came in. And there is a bit of luck involved in that the end market was already recovering. Travel is recovering post-COVID. And just remember, by the way, that this is the Rolls that makes jet engines, not the Rolls that makes cars. Two completely different companies. This one makes jet engines. And the way it makes money, it doesn't actually make any money on the engine. You can see here in this picture. It only makes money on the servicing element. So it makes money on the spares, and it basically charges by the flight hour. But it's done very well under a new chief exec because he's taken out a lot of cost and he's put up the price and he's made sure that contracts are actually enforced, which sounds quite simple, but it's made a huge difference. So the UK does have world leaders. Rolls is one, and it's one that's finally realised its potential. So this is our biggest holding in this fund, but we are now reducing it. And I'm just going to turn on to where we are funding these types of opportunities from, because I think it's very tempting as a fund manager to talk about your shiny new buy idea. I definitely fall into that camp. I'm not excluding myself from this. But disciplined selling is really important as well. And you cannot fall in love with companies. I'm going to give you one brief example. If you look at a company like Croda, which is a specialty chemicals company, we owned it for, obviously not all under me, but I honestly think we owned it for about 20 years. And we sold it finally in November 2021 for £98. And it had been, and is, a brilliant company. You know, it makes fantastic margins. It's got a huge intellectual property in there. And it's now, so we sold it for £98 and it's now just under £50. It's still a good company today, but it got to 42 times earnings when we sold it. It's still now on over 30 times earnings. We haven't bought it back. Hopefully, I'm really hopeful that we have the opportunity to buy it again at the right valuation. But you have got to be so disciplined. We are, you know, Dan mentioned what type of investor people are. We are value investors. So we can't fall in love with companies. We need to keep recycling to where we're seeing the best value. Geographically, I think I've made clear at the moment we see the best value in the UK. So we have also been selling some of our US holdings, such as Applied Materials here and Caterpillar. Just to briefly touch on, if we flick to the next slide, if we briefly touch on Law Debenture as a structure, I would really encourage anyone who's interested to Google Law Dem and go to their website. There's a lot of great information on there with a lot more detail. But briefly, Ian James run the investment portfolio, which is 80% of the NAV. And then there's a separate independent professional services business, which is 20% of the NAV. This is the likes of pension trustees, there's a corporate trust business, whistleblowing, a big diverse range of independent professional services businesses. And it's run completely separately. And it's 20% of the NAV, but most importantly, it's about a third of the dividend. And what that means when it comes to running the portfolio, if you flick to the next slide, is that it broadens the investment universe for me and James. So we don't have to hold the higher yielding, larger companies that you see very often at the top 10 of UK income funds. And it has benefited the performance hugely that we don't have to hold some of those higher yielding companies that are possibly in structural decline. Think here, for example, we hold nothing in tobacco, and that has really helped the performance to not hold an industry like that. And then at the other end, we can hold lower yielding shares that have been often our best performers. The best performer for this fund over the last 5 years has been a hydrogen fuel cell company called Ceres Power. You would have struggled to hold that in any size in a traditional income fund structure. So even though it's a very unusual and you could even argue unique structure, it has been hugely important to the long-term performance of this fund. And if we click to the next slide, we can see that performance. You can see at the top here, the NAV Total Return has outperformed the FTSE All-Share benchmark over 1, 5 and 10 years. And I think the 5 and 10 year numbers I think are particularly important because we have a long-term time horizon, and I think our shareholders do too. And you can see on that 10-year number, the outperformance has been over 40%. So we're really pleased the structure is delivering for shareholders. And then if we flick to the dividend, The dividend has roughly doubled over the last 10 years. You can see here it's gone from about 16p to over 30p. As I mentioned, it's about a 4% yield at the moment. And we are the fastest income growth in the AIC sector over the last 5 years. So just to finish very briefly, we do have a unique structure. I've only touched on it very briefly here. I would really encourage anyone to go and read about it in more detail. But it has really helped our performance having that unusual structure. And it's allowed us to focus on growing the capital rather than necessarily focus on having to focus on some of those higher yielding companies that might be in decline. And then just to finish on the UK, I really do think there's a value opportunity here at the moment that is unusual, and we're seeing that most clearly in the takeover activity that we're seeing. And this portfolio is positioned to take full advantage of that UK valuation opportunity. So I'll stop there.